Hi, I'm Jeff Parks. I'm the manager of Home Security Financial. And today we're going to talk a little bit about some of the things that are complicated and scary to all of us, namely the financial markets and all that's been going on. I've attempted to make this a simple presentation because I understand that the subject itself is incredibly complex. So follow with me as we look at the economy as we see it today. Basically, the U.S. economy, like anything, is supported by two pillars. And those pillars are liquidity, or another word for liquidity is credit, and the confidence of the American population and banks in the entire system of credit and payment. Well, this has all been fine up until recently, but then something happened, and I think you all know what it is. It began in the summer of 2007 with the subprime meltdown. This was credit falling apart for people who had had bad credit to begin with. The second thing that happened just recently is the failure of IndyMac Bank. And when was the last time any of you remember a bank failing? And you can't count Washington Mutual. Right after that, we had Bear Stearns, and Bear Stearns is a large investment company, actually an investment banker, who obviously had some pretty serious financial problems recently. And after Bear Stearns, who came next? AIG. AIG is one of the largest insurance companies in the world. It's worth almost $1 trillion in assets, but they're faltering as well. Well, you can start to see with these kinds of major problems how the U.S. economy started to falter and confidence started to be shaken. Then probably the most interesting of all was FNMA and FHLMC. That stands for Fannie Mae, or Federal National Mortgage Association, and Freddie Mac, the Federal Home Loan Mortgage Corporation. These two entities were taken over by the federal government. We now call them FEDI. The next shoe to drop was Lehman Brothers, again a very large, respected, 100-year-old investment house, and right after them, Merrill Lynch. These are household names to anyone who's ever invested in anything, in bank stocks, in money market mutual funds, anywhere. And so because they're so well known, they really shook the U.S. economy. Based upon all these things, and then Washington Mutual just within the last week was taken over by the feds and basically sold to Chase. Because of all these things, confidence in the U.S. economy was shaken. The Federal Reserve tried a variety of different things to fix this. They injected money into Fannie Mae and Freddie Mac. The Treasury took over some banks. But the real shoe to drop, the one that really terrified people, was this. I'm certain that many of you have money market mutual funds. You have money invested in the mutual fund industry. It's a real common, safe place to keep your funds. What if you knew that that was not insured? What if you were afraid that your money in this money market system was not secure? That would shake you to your very foundations. Well, that's what happened. Because on Thursday, September 18 of last week, $105 billion was removed from money market funds by people like you in a panic that this money was not secure and it had to go somewhere else. And you know where a lot of that money went? People bought treasury bills. They bought treasury bills so frequently and with so much gusto that the yield on the treasury bill dropped to zero. In other words, people were willing to take nearly $105 billion and put it into a non-interest earning account just to make sure they'd get it back. That's pretty amazing. When the Federal Reserve and the U.S. Treasury saw this, they became very alarmed and they called an emergency meeting. They decided action was required, and so over this weekend they crafted a plan to try to save the U.S. economy. Number one, they decided to limit short selling. Short selling is the practice of buying a stock that you do not own and selling it when it goes down. The result is that it causes something of a panic because Wall Street watches short sellers to see if their bet that a company is going to fail or a bank's going to fail is correct. Limiting short selling then took some of that speculation out of the economy and might have slowed things down a little bit. But the key is that all of these actions that were taken that weekend were far more serious than any of us ever knew. There's a movie I'm very, very fond of called 13 Days in May. That movie is a depiction of the crisis that occurred when the U.S. government, under the Kennedy administration, was faced with missiles going from Russia to Cuba. Those missiles could have certainly taken out the United States. During 13 Days in May, we came that close to nuclear destruction. And it was only the first person that blinked that caused that not to happen. This weekend, when all of these actions took place, was like that 13 Days in May. This was a time when we came very close to the destruction of our financial system overnight. The second action that was taken was that the Treasury decided to buy mortgage-backed securities. Now, for those of you that don't understand that term, a mortgage-backed security is an investment that is backed by mortgages. Well, those are, as we now call them in the financial business, the stinky trades of all time, because right now nobody knows how much they're worth. Banks carry these mortgage-backed securities on their books, but the banks don't know how to value them. And the reason they don't is something called mark-to-market. Mark-to-market is an accounting principle that says in order for you to keep a certain asset on your books, you must value it at its current asset value. Well, none of you watching this video would be able to tell me how much a mortgage-backed security is worth because that security is comprised of hundreds of thousands of mortgages. Some of them may be people that have a 50% equity in their home and have an 800 credit score and are making their payments every single month without fail, even early. But then a large portion of them could be people who are facing foreclosure. So it becomes very difficult to try and figure out what is the value of one of these underlying securities. Now, because all of these stinky mortgage-backed securities are sitting on bank books, they are messing up their balance sheet and preventing them from lending money. So the Federal Reserve and the Treasury Department, or FEDI as we're now calling them, has decided to try to find a way to buy those securities from the banks, thereby taking them off bank books so that those banks are free to lend again. They don't know whether they're going to do this with an auction or whether they're going to hold these assets for resale at a later time. There's a million of proposals out there, and if you want to bring this right up to date, this presentation is being filmed after the House of Representatives has turned down the first run at accepting all of these proposals. So we're not even sure what's going to finally happen when it's all said and done. Anybody that remembers the RTC knows that what the RTC did was to take on real estate, house by house, and then sell them like in a foreclosure auction. What's going on here is far more complicated than that. The third thing that this committee wants to do is to insure those money market mutual funds that I just scared you about. Once they're insured, there'll be confidence in keeping money in money market funds, which allows money to flow more freely in the U.S. economy. Some other proposals that came up in this meeting over the weekend included a proposal to limit the golden parachutes available to CEOs of some of these banks that were selling these mortgage-backed securities. A really good example of that would be if I were the CEO of a particular bank that had all these stinky assets on their books, and FEDI took those assets off my books so I had more money to lend and maybe took over my bank. Do I get paid $100 million to thank me for all the bad work I've done? I don't think so. And that's called a golden parachute. And so integral to this proposal is to make sure that that doesn't happen for CEOs, that they're not wrongfully compensated. A fifth portion of this proposal has to do with whether or not it's better to buy these assets or whether it's better to merely insure them and not buy them, very much like what the FDIC does now with your bank accounts in a bank. And that's part of the proposal that's ongoing now. We're not certain what's going to happen with it. I've left out number 6 because there's certainly more to go. Here's some facts for you just to let you know where we stand today. In the United States today, 6.6% of all the mortgages currently active in the United States are 30 days late or more. That's a pretty amazing statistic. In the state of California, 7.7% of all the working age people in the state of California are unemployed, and it appears to be rising. Is lending going to stop? Well, I told you about the 0% T-bill yield. That seemed to work for everybody. So how are we going to get this mortgage back on track? How are we going to make sure that money will flow through the system?